everybody.
Morning. You're going to grab a mic, or why don't you grab my mic, Todd? Or you can stay right there.
Can I use this?
Yep. You have to click it up, click the green light.
Do you have a click?
Great neck today.
Is there a clicker for the slides yet? Can you hear me?
Mark, is there a
Yeah.
clicker?
I'm going to show you some. Yeah, I'm the.
Oh, you're the clicker man.
Dan's the clicker man.
Okay. All right. Well, so I'm for those of you who don't know me,
Actually, you know what? Take a clicker. We don't want to be the clicker man.
Okay.
Thank you. Thank you.
You have it up? So anyway, while he's getting up, so I used to work for T. Rowe Price and retired, and then spent some time with Greenspring Associates, which was a venture capital firm. The guy that started that used to work for me at T. Rowe Price, and we co-wrote the business plan for a pretty unique venture approach. And then I just am an active investor in companies and sit on a whole bunch of boards, but I'm an advisor and put up some of the money to start Access Holdings, which is a lower middle market build and buy digitally enabled private equity firm that focuses on essential services businesses. What do I mean by essential services business? Things that are kind of recession proof: school buses, insurance, car washes, pest control, fire and safety, things like that. And we'll buy a company, and then we'll grow that organically, and then also do a lot of M&A to grow it around there. But where we focus is in the middle market, actually more of it in the lower middle market. So as I say, I don't work there, I'm just an advisor. But a lot of people really don't know what the middle market really is and how important it is to the United States. So I'll give you some slides on that. But before you get into that, there's so much talk about all this money moving from the public markets into the private markets, and where should you be? Well, you should be allocating to both. But I'm going to start off with some interesting data on what's happened over the last 24 years in the public and private market, all on one slide. So you can see here that back in 2000, there were 7,300 publicly traded companies, and that's declined over 40% to 4,300 today. That's a function of mergers, of bankruptcy. By the way, I can send the slides. You don't have to take photos. If you give a card to me or get a hold of Mark, and nice. But it's a function of bankruptcies, mergers, and take private. 24% of the top 10 stocks back in 2000, up to 34 now, but I find it very interesting. 4%, the top 7 stocks accounted for 4% of the S&P 500 back in 2000, and 22% now. So you know the seven stocks now, the Magnificent Seven. When you add together their market cap, it's $14.5 trillion. Anybody have an idea who the top 7 were back in 2000? Guesses? No? Exxon, good. Exxon was number 2. With a, what was that? Nope.
Cisco?
Cisco. General Electric. Yeah, General Electric was number 1 with a market cap of $300 billion. ExxonMobil was number 2 at $296 billion. Pfizer was number 3 at $275.
What was T. Rowe Price?
T. Rowe Price and Microsoft went public in 1986. I was there when it happened, and it was the 2 biggest IPOs that year. But Microsoft has outstripped us. So what did I say? Pfizer was 3. Cisco at $245 billion was 4. Walmart was 5. Citigroup was 6. Boy, they've come off. And Intel was 7. So only 2, Cisco and Intel, and now all 7 are tech companies. But it's interesting here, if you take a look at the change in the public market from 12 trillion to 40 trillion, that's 233% increase. Now let's take a look at private. You had 760 PE firms back in 2000. Now you've got over 3,000. And the total assets were $650 billion back in 2000, and now it's 8.2 trillion. That's a 1,162% increase. The money that's flooded into the private markets is amazing. But what I'll tell you here is that the vast majority of that money is going to the few, or is targeting the few firms that are at the top of the food chain, where the vast majority of the companies in the United States are a lot smaller. That's the area that we go after at Access Holdings. So let's take a look at that. So this is businesses in the United States. There are 33.2 million companies in the United States. Only 5,300 of the 33.2 million have revenues of greater than $1 billion. The middle market is defined as companies from less than $1 billion to $10 million. There are 29,000 of those. But you look at that, large companies, that's 0.02% of all of the companies in the United States. Middle market companies are 0.63%. And the vast majority are below $10 million. Now you can hoover up a lot of companies, $10 million or so, put them together, and there's not a lot of competition for that. So the opportunity there is pretty attractive. The middle market companies are the backbone of the United States. They employ 48 million people, and they account for over a third of GDP. Now, the next 3 slides that I show you are going to demonstrate the critical contribution that they have to the U.S. So this is, the blue line is companies in excess of $1 billion, and the black line is middle market. And you can see, going back to this slide, you know, most of the middle market is the lower middle market. But this slide combines them together. And if you just go back to the fourth quarter of 21, where middle market companies revenue growth 12.3% and large companies 8.6%. From there going forward, very stable and healthy growth of middle market companies, but not so a rapid decline in large companies. So strong revenue growth in the middle market.
Can I ask a question?
Oh, sorry. Yes.
Can you just go back to that chart for a second? Do we use mics or?
Heinz, you mind? Yeah, if you could.
So
It's not on.
So a mic that turns on. So that whole long column of companies, how many of those companies are private and how many of those companies are public? Do you have a rough idea?
I would say the majority of the companies over $1 billion are public. And the majority of the companies below 500 million are private.
And you help with some of that transitioning?
Well, we buy all these small companies and then we'll package them together. We're trying to build modern businesses. Take a bunch of smaller companies that really are not that modern, pull them together, and add a lot of value-add tools and digital tools to them to make them modern businesses. And then we'll either sell them to a private equity firm or to a strategic buyer.
Thank you.
So here you go. You know, revenue growth much stronger in the middle market than with large corporations. Employment growth. The middle market is the engine of employment growth. From the fourth quarter of 21 to the second quarter, we just don't have the data yet for all of 24. That's an average of 10.5% increase year over year, whereas in the large market it's 2.3. So that's a 3x increase, or 3x larger in the middle market than the large market.
The National Center for the Middle Market.
Yeah, they just haven't come out with their more recent report. And so this takes a look at financial performance, and you can see here that revenue growth is 3x higher in the middle market than in the large market, and earnings 1.7x higher in the middle market. So a real engine of growth. So here's the big dilemma. These companies that are performing better from a financial standpoint, their employment growth, revenue growth, are a lot stronger than the large market. But where's the private equity money going? It's going to large buyout funds of $2 billion or more. is that huge spike up. So all of this money is chasing just those few companies at the top. And so what that shows, another way of looking at this, is a huge mismatch between the amount of money raised by the large buyout players and the amount of money that's deployed. Another way of looking at it is this page. You've got $774 billion of capital raised to be going after just a few companies, whereas there's all this additional money, or $141 billion of capital raised going after the lower market. Huge mismatch. And so there's an alpha generating opportunity in the lower middle market that you don't have in the large market. And a lot of that large market growth in the past has come from a lot of financial engineering. And a lot of that is not going to be available. So the private equity firm needs to provide a lot of value-added services to their companies. And then just this looks on the credit. Oops. This looks at the discount that you're getting, and it makes complete sense because of the overhang going to the large market. And then this is interesting. This is leverage. 47% higher leverage used in large PE market than going after smaller companies. And then on the credit side, you can see that on the left-hand side, cumulative default rates, this is from 1995 to 2000, cumulative default rates in the mid-market are actually quite low relative to the broadly syndicated loans in the high-yield marketplace. And the recovery is a lot higher. So now I'm just going to give you, we did this, we have a controlled research group at Access Holdings that's called NOAA, and we utilize that for a lot of work. So we did this comprehensive middle market survey. We surveyed over 521 executives of lower middle market and middle market companies. And the findings demonstrate that there's a need for adding a lot of support and money behind technology, human capital, and capital access in the lower middle market. But the report provides a lot of actionable data for middle market companies to seek to work on. So I've just selected a few pages or a few summary data. If you want the whole report, again, I can provide it to you. Okay, this is not moving forward.
Second. What now?
Okay. All right, so when strategic business planning, in which areas do you leverage technology to make data-driven decisions? You can see the striking gap between large companies and smaller companies. Smaller businesses struggle using technology to improve processes, specifically in competitor research and analysis, and pricing, and customer segmentation. So lower middle markets, or middle market and lower middle market companies struggle a little bit with tech to help them on strategy. They're in what? If you're a PE firm focusing on this, it's not just capital that you provide a lot of support. This is digital innovation. Again, striking difference, a significant opportunity for middle market companies to improve digital use. And so this is not surprising data because most of these smaller businesses have poorly defined processes. Next, if your company is currently using artificial intelligence, how is it being deployed? Dramatic difference here. Again, if you're going to help these lower middle market companies as a private equity firm, you need to help them and provide that kind of support to them. But I mean, pretty dramatic difference here. Next, let me skip this and come back. Financial reporting. One of the key reasons smaller companies struggle to get financing is that they've got really poor forecasting and budgeting, financial auditing primarily, and budget actual work. So it's important to really work with these organizations to help them improve that. By the way, I screwed this up. The high numbers there, the 70%, 80%, and that should be smaller companies, not larger companies. But what are the largest challenges you face regarding human capital? And they need a lot of help. It's interesting to see that they perform better than the larger companies, but they need all this additional work. I'll come back to this slide. Which outcomes do you expect when working with an investor? Smaller companies typically are getting bank loans, and they need a lot of advice on funding sources, whereas large companies don't do that, and they mostly are utilizing the equity markets. So last slide. Untapped potential in the lower middle market. They're resilient. It's a large part of the universe. Smaller funds have outperformed larger funds, although they're not as well seen in the marketplace. It's not the Carlyles or the Apollos. It's the Access Holdings that you probably never heard of. And I think you're going to eventually start seeing some of this. I think when returns aren't coming through with large buyout, you're going to see some of that gravitating down. But they're going to need to have the capabilities in-house to be able to support the underlying companies. So with that, that's all I have. I'll take any questions, or I'll get off the stage and let Ken get on.
So my friend Andrew was wondering why you have to use Kenyan colors on some of your slides.
Because they're a lot prettier than Denison colors.
Then I reminded him that Antler had Denison colors.
You're right.
You have a lot of great data as usual. Questions? Thoughts?
Yes.
You think the allocation of funds between large and smaller is a perception of quality? Because
Yes.
everyone's trying to chase the quality.
Yeah,
So I'm wondering if that's one of the key drivers.
It is. It's also a lot of the money that's going in there are big sovereign wealth funds and insurance companies that have to push a lot of money, and the smaller funds don't have it. But the same, as
They're waiting for the roll-up.
yeah.
They're waiting for your roll-up to.
But it's the same thing in the venture marketplace. There's a bifurcation. There are the asset gatherers like A16Z or General Catalyst, and then there's these smaller firms like Antler and others that may perform better, but there's a perception that if you've got name brand recognition, you're a better performer, and that's not true. But it's
We
human
got
nature.
some work to do on that.
Yeah.
One more question too on, can you talk a little bit about the exits? Because if you're a smaller fund with smaller companies, it's probably easier to exit your positions, right? Because you can sell to the larger funds, or you can,
Yeah.
there are more opportunities.
There are a lot more opportunities. Yeah. Let me just give you one example of a roll up we did, and I'm not cherry picking because there's a lot of good ones, but we studied the insurance market. And we found that life and annuity providers, it's a very, you've heard of the Prudentials and the AXAs and all, but there's a lot of mom and pop insurance companies out there that you never heard of. So we found an insurance company, and a sleepy little insurance company, a life and insurance company in Louisiana. And at the end of 2016, we acquired it. At the time that we acquired it, it had $47 million in written premium and $500 million in assets under management. We grew that organically, and then we did M&A around that, and today that $47 million of premium is $8 billion, and that $500 million in assets is $42 billion. I can give you examples of car washes and a lot. I mean, it's really it's an interesting approach. Yes.
What period of time was that?
2016 to the end of 2024.
Very quick. Are you taking capital? Are you liquidity terms? What's your performance relative to your peers?
We're not taking capital. We're not going to raise our third. We've raised two funds. One was $340 million, and the second one was $525. We're not going to raise capital again until the end of 2025. What was it? Liquidity?
Yeah, what were liquidity terms and what's your performance relative to your peers?
We haven't had any liquidity events out of our first fund. It closed in 2020. So I can't give you a number. We've got two companies that we're selling right now. One is a car wash company, and the other is a media rights in the entertainment space, sports and entertainment space. And those should close sometime before hopefully this should be before June. And they both should be very, very attractive exits. And liquidity term, I mean, we expect to have a hold period of about 5 years and before we're building things up. 5 to 6 years before it's in.
So Todd's not running away. Some people come and run away. That's not Todd. So he'll be around. Ken Goldman is here. Ken Goldman has done presentations from an airplane, like literally.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.